Good afternoon, everyone. Thank you very much for joining us. This is our ad hoc webinar, Mistakes Made by Traders. My name is Russell Shaw. I am the Senior Market Specialist at FXCM. And please take note of my email address. So if anybody wants to correspond or send me any questions or anything that comes to mind, please send it through to this email, rshaw@fxcm.com. And today is, for the record, Monday. It's the 20th of January 2020. And my time, it's 2 p.m. UK time. We're looking at 12 p.m. And I hope that everyone's having a good start to the week. So just to give a short introduction, I'll do that while we actually got the disclaimers on screen so we can kill two birds with one stone. Usually when I do webinars, I have a chart in front of me and we do analysis of charts, and it's very, very interactive, and that is different to the way we're approaching today's webinar. Today's webinar, to be honest, it's difficult because it's very theoretical. But when I say very theoretical, everything that we're going to discuss this afternoon, is of tremendous importance. And I think that as traders, when we go through the presentation, what we will look at will sound very, very familiar to every single one of us. Let me just bring up the next disclaimer. This is our market commentaries, and while there won't be specific commentary in this webinar, I'll just keep it on screen for a few moments for your convenience. Now, what I would like for us is to try and make this as interactive as possible. I think that if you have any questions or comments, or even want to debate a point, don't hesitate. Type it through. I'll read it out to the attendees. We've got a fair amount of people attending this webinar, and we'll open it up. But the more interactive we make it, I think the more interesting it will be. And I want to encourage that, just because it is more of a theoretical type of approach, although important and needs to be applied practically. We're not looking at individual charts. Makendra, no worries, we're just starting now, so no worries, you haven't missed anything. Okay, so the first question I have for everyone that is attending this webinar is a very, very simple question, because it's going to determine how you approach the market, and it's also going to prevent you from making mistakes, and you'll see what I mean in a moment. So the question I ask is as follows: what type of trader are you? Are you a shorter term trader? Do you look for swings? Do you position yourself in the market over a period of time? It's very important to define what type of a trader you are. And you may not be specific to one category, but the idea here is that you've got to know the trade you're taking in terms of the category for that trade. Let me explain. There's a mouthful there. Very, very important. If you put on a position and you're looking to take a swing, you're looking to just swing trade it or even day trade it, and the next thing you know is you're actually sitting in loss. And we've all been there. We put on a trade And on occasion, or perhaps more than an occasion, we sit in loss. And the initial trade we're putting on as a day trader, and all of a sudden, because it's not going in our favor, we switch to being a day trader, and all of a sudden we've become a positional trader. And we're now saying, okay, I'm happy, the market's against me, but I know it's going to come right. And I thought that I'd be in this trade for a lot quicker, but I'm convinced the market's going to move into my direction, so I'm going to change my strategy and become a positional trader. So let me start. Has anybody done that? If anybody's done that, type Y. Type Y. Let me just see if there's anybody. Has anybody done that? Put on a trade, and then all of a sudden they are adjusting the way they have originally or initially approached the market. Alex says panic. Exactly. So right at the beginning, okay, and I think that this particular slide, define yourself as a trader, I think this is going to really lead into the rest of the presentation. Because when we put on a positional trade, it's a very different approach to scalping for a few pips. Right off the bat, a positional trade will have a much smaller position size, okay, and it will have a much larger stop loss, whereas a scalp will probably have a very tight stop loss and a much bigger position size. So as soon as one adjusts from going from a scalper to becoming a day trader to becoming a positional trader, or maybe even a swing trader in between, you're actually starting to adjust your risk profile. Starting to adjust your risk profile, because at the end of the day, what trading really is, and this is going to be a major theme throughout this afternoon, is that we really are risk managers. That's really what we are. We're risk managers. If we don't manage our risk appropriately, okay, well, then at some stage, risk is actually going to turn around and bite us. So it's very important to know what type of a trader you are so that you can put on the appropriate risk. And that's the first mistake that we make as traders, that we come to the market and we haven't actually defined exactly who we are. And we're going to refer back to this concept again and again and again this afternoon. Now, the market in and of itself, okay, is opportunity. If it didn't give us opportunity, why bother? But the next slide that I pose is, are we coming to the market with the correct expectations? Are we coming to the market with the correct expectations? I'll come back to this beginner cycle in a moment. It ties in with this correct expectations. Now, are our expectations aligned with reality? I know that a lot of the clients that I deal with on a daily basis come into the market. They come in with a account size that is suboptimal. Okay, suboptimal. Now, I don't mean to say that in a derogatory manner, but the account that they opened up is a very small account, and the expectations are not aligned with that type of an account. Okay, the idea is that they're going to grow this small account size into a mass trading account. Alex says we all dream about getting the millions. Okay, we generally all well, the truth of the matter is, okay, we all want to make money quick. Okay, we all approach the market with this get rich quick mentality. And perhaps I'm generalizing when I say we all approach the market with that type of a mindset, but I can speak from personal experience that when I approached the Forex market, and it was round about 2009, 2010, when I started moving almost exclusively sort of to Forex, it was because I really wanted to be aggressive, wanted to build the account as quickly as possible, and really wanted to get rich as quickly as possible. Okay, so the um, the fact is, we come to the market, we haven't defined ourselves as what type of trader we are. We want to get rich quick. If we put on a quick trade, it goes against us. All of a sudden, we decide we're going to positional trade it. So we slow it down, all in the hope of that we're going to close the trade in a profit. And this leads to a host of problems, Alex says, how quickly did I lose the first 10,000? Exactly. I'll tell you some anecdotes as we get into it. But the first couple of months, or even the first year of trading the Forex market, personally, I was exceptionally aggressive. I was a cowboy. And I was averaging down. When the trades went against me, I was averaging down. And again, we'll talk about that. Hey, Eric, nice to have you with us. But it worked. It worked 9 out of 10 times. The only problem is the 10th time, the one time it didn't work, it cost me almost the entire trading account. Okay, so these are mistakes that can be avoided. Okay, they seem like they're good ideas until they're not. We'll talk about averaging down later, but right now I want to make it very clear that defining ourselves as a trader is very important, and understanding that we generally want to make money as quickly as possible, and it leads to a whole host of problems. Okay, so these are just some of them that come to mind. When we approach the market, we haven't got a defined time horizon, we don't have a defined trading plan. We start forcing trades. So let me give you an example. We want to come to the market. We want to make money as quickly as possible. We've got a specific entry criteria. Let's just say the entry criteria is a price crossing above the moving average, just very simple. And we look at our specific chart, and none of our pairs or instruments that we watch have conclusively crossed a moving average. None of them have conclusively crossed the moving average, but there is one that is on the cusp of pushing over and crossing. It's just on the cusp. We can see just at the top of the hour, as soon as this hourly candle completes, it's going to be a bona fide cross. Well, let's go in now. Okay, we can go in now. We'll catch the trade early, and we force the trade. In other words, our entry criteria haven't been met. We can see that it's about to be met, so we force the trade because we've got a compulsion to make money as quickly as possible. The only problem is that at the top of the hour, the candlestick has now reversed. Sellers have come into the market and started pushing price down aggressively, and there hasn't been a bona fide crossover. So we've forced a trade. We've gone into a position which we should never have gone into initially, and now we're sitting with a loss, all because we want to make money quick. It's the same thing. It's what we call chasing the market. Chasing the market is very, very interesting. If you take a look at I'm just thinking the DAX. The DAX on Friday had a terrific swing. It was the only swing really that locked in for the whole of last week. The whole of last week we looked at the DAX. We've got a DAX webinar, and every time we looked at the DAX webinar, it was crossover signals. It looked like it was starting to swing. We got into the trades, the trades cancelled out. No harm done. There was no real runoff. There was no panic. It's just that the setup conditions evaporated. We had no choice but to close the trades. It was frustrating. We were whipsawed constantly from Monday through to Thursday. We were constantly whipsawed in and out of the DAX, except on Friday. On Friday, it ran. Okay? On Friday, it ran. Now, we want to make money as quickly as possible, So let's just say we are busy on Friday. Let's just say we are busy on Friday, please. Okay, let's say we are busy on Friday, and the idea is we come back to our office. We come back to the office. We see that the DAX has run. It's run tremendously hard, and we're kicking ourselves because we haven't been a part of that swing. So what do? We enter long. We enter long because the market's run. We're late to the party, but let's get in. It's running. That's chasing the market. Okay, so the first example, forcing a trade, is slightly different. Forcing a trade means we enter the trade without a real signal. Chasing the market is we enter the trade well after the signal, all because we're trying to get rich as quickly as possible. The problem is with the former, forcing a trade, we never get the signal and we end up in a losing position pretty quickly. The latter is that we are entering into a swing fairly late in the swing and it's going to reverse. It's going to run into exhaustion and it's going to reverse. Okay, so why did we force a trade? Why did we chase the market? It's because we're trying to get rich. We're trying to get rich and we haven't truly defined ourselves as a trader. We haven't truly defined ourselves as a trader. If you've defined yourself as a scalper, it's very different to a positional trade if you chase the market. Forcing a trade and taking a trade with no setup is very, very similar. There's no opportunity in the market. We all want to bank the pips. There's no opportunity. If we don't trade, how are we going to bank the pips? We're not going to grow our account. We don't grow our account. What's the point of trading? What's the point of trading if we're not growing our account? But we can't grow our account if we're not trading. So we're going to just put on the trade anyways, and hopefully it will go our way. We take the trade with no setup. Why? Because we are terrified of missing the move. Absolutely terrified of missing the move. Does any of this resonate with you guys? I want to make sure that we're talking about the same things. Has anyone ever done this? I got to tell you, from my point of view, it's something that I battle every day. Even today, battle every day to control myself. That's the discipline of being a trader. And the fourth one over here, okay, has anybody done this? Revenge trading. I'll explain it to you. Sherlin says, still battling. I think we're all battling there, Sherlin. Absolutely. Alex says he's done all four. Revenge trading is exceptionally damaging. These are all damaging, but revenge trading, let me give you a story. Okay, I once sat in our boardroom with a client, and this particular client hadn't done particularly well. In fact, a good portion of the trading account had been lost, and the basic idea was he had no trading plan, he had no defined strategy. And I said to this person, I said, look, you've got to stop. Okay, you've got to stop. And I think that we've got to perhaps have a discussion, and we've got to try and see if we can do things in a better way. And he says to me, definitely. But let me first trade and get all my money back. So let me trade and get all my money back. Okay, I think at this stage it was down 50%, the trading account. So if the account's down already 50%, okay, just mathematically, it means that the trader has to make 100% just to break even. It's almost impossible. Okay, it's almost impossible. Another application of revenge trading is that we go into a very, very good position. It meets all our criteria. All the check boxes have been ticked. It's time to go in, and it moves against us. Okay, actually hits our stop loss, and we out. And because the trade, all the check boxes were ticked, we're actually very, very angry with the market, tremendously angry with the market. The market didn't cooperate with our analysis. So now all of a sudden, because of our anger, we dig our heels in, we become steadfast, and we put on another trade just to get our money back. We revenge trade. And the trade we take to get the money back is ill thought out. The next thing we know, we're down on the second trade. And it's almost circular because it builds on that revenge trading mentality. Okay, it builds on that revenge trading mentality. Now, these are all because we all want to make money quick. The truth of the matter is that financial markets are lucrative. They're lucrative, but one has to apply themselves in a very disciplined manner and let the power of compounding do its thing. It's highly unlikely to get rich quick. And the people that do it, I would offer, are very, very lucky, and perhaps are not really going to end up keeping it as they continue to trade quickly. Let me see, I've got a question here. Alex writes, man, this reminds me of the first month trading futures. I lost 50%, got the same advice, and after a few weeks, it was all out, all 20,000 US dollar, and that was some money back in 2005. And I can tell you, Alex, it's happened to all of us. You know, the idea here is that trading, and what this is really all about, what this webinar is all about, is to I guess make us aware of how counterintuitive trading is. It's counterintuitive to how we behave in most circumstances. In a latter slide, I talk about controlling the market. We all come to the market thinking that we have some control. The truth is we have very few variables that we can control in the market. We'll talk about them in a moment. Very few variables, and it is usually the individuals that have exceptional control in their vocations. So just as an example, it's just sort of an example of coming straight to mind. Say a doctor. Okay, a doctor has tremendous control in his consulting or her consulting room, that the patient he or she sees has a specific condition. The doctor is very well schooled and trained, knows exactly what the condition is, knows exactly how to treat that condition, and applies the remedy. There is a mass amount of control. Okay, the doctor has a mass amount of control in that environment, and the idea is, okay, you come to the market as a professional, and we all have a certain amount of control in our vocations. We come to the market and we think we're going to have that same level of control, but we don't. Okay, we think the market's going to go up, so we put on a long position, and the next thing, it's going down. So whatever control we think we have is just an illusion. It's very difficult for the human condition to appreciate that. Sandelia, I see your question. Keep that on the back burner. So Sandelia asks, how do we separate emotions from trading? Okay, so we'll come to that. Hopefully by the end of the presentation, we'll have answered that. But if we haven't, I'll have a Q&A towards the end. So the idea here is, okay, to understand that there's very few things we can control in the market. One thing we can control is our approach to the market, our trading strategy, okay, which is very much linked to how do we define ourselves as a trader? How do we define ourselves as a trader is very much going to determine what your entry criteria is, what your exit criteria is. Now, one can perhaps be lucky enough to be taught a good system or develop a good system or find a good system. But if we go back to the very first slide, okay, we're all going to suffer from what we call the beginner cycle. The beginner cycle, which is entrenched in this, what type of trader do we define ourselves as? So let me tell you what the beginner cycle is. And it comes from an Australian trader, terrific trader by the name of Nick Raj. And what Nick says is that eventually we'll settle on a system. We'll come to the market, we're going to settle on a system. And we'll start using the system. Now, either the system is perhaps a system that is not specific for the type of trader that we truly are at heart in terms of our psychology. So day trading's very, very pressurizing. Perhaps some of us can't take the pressure of day trading, and perhaps it's a day trading system. Okay, so all of a sudden you apply the entry rules of the system, and it's just too much pressure on the trader psychology. So that might happen. A second option, of course, is that it lands up making a loss. It's a perfectly, it's a very competent system, but it makes a loss. Anyways, the trader again tries it a second and a third time, and there's a second loss, a third loss, and by now the psychology has really taken a massive hit. We all I think have been that. We start sweating, we don't know what to do. So we hop from system A onto system B. System B gives us a different set of entry exit criteria, and we start trading that, and all of a sudden we start incurring losses with system B. So what's happening here? We are incurring losses with system A, we're incurring losses with system B, so we hop to system C, and the cycle continues. And I think we've all got to understand that every single system, bar none, every single system has a cycle to it. It's going to have a cycle where the trades are going to be good, and the system entry is in sync with the way that the market is, and there's going to be a drawdown. There's going to be a drawdown period with the system. Now, what tends to happen is that we're okay as long as the system is in sync with the market. That's perfect. Okay, then we're happy with the system. But as soon as that system rolls over and goes into its drawdown period, we're no longer happy with it. We think it's broken. We think it doesn't work, and we've had enough. It's time to get rid of system A. Let's jump into system B. The problem with system B is it's susceptible to exactly the same rule, is that in some parts of the market, it's going to become synchronized with the way the market moves, and it's going to make profits. But at some stage, okay, as market conditions adjust, it's going to move into losses. And that's just with every single system. Every single system will have a drawdown period. The problem with beginners, okay, number one, is that we haven't defined ourselves in terms of our time frames, and number two, we're not prepared for the drawdown periods in our systems. So as soon as a perfect system goes into its drawdown system, we start jumping across, looking for other systems, searching for the perfect system, the one that never makes a loss, the 100% system. The 100%, we all search for it. And the problem is when we jump from system A and we jump to system B, and then we jump from system B into system C, we tend to be jumping at the part just where the drawdown system is starting to end. So we'll jump from system A just as system A's drawdown period is starting to end, and it's starting to synchronize with the market again. We jump out of system B, just as system B is starting to synchronize with the market again. And we are continuously jumping from system to system to system, trying to find the perfect system. In other words, think about how this ties in with what type of a trader is. Are we what kind of trader do we define ourselves as? Let's say we're a swing trader. The swing trader has a pretty good win percentage, and it makes a number of trades, and then all of a sudden it rolls over into its drawdown period. Well, no, we don't want system A anymore. We're going to go into system B. System B is perhaps a positional trading system, and as we jump into system B, guess what? The swing trades start syncing up with system A. And that's the beginner cycle. And it's very difficult to get out the beginner cycle. We jump from one system to the next system to the next system. And I'm telling you that that is a mistake. The idea here is to understand what type of a trader you are and to understand that all systems have periods of drawdown. Does that make sense to you guys? Is there any comments at this stage? Please go ahead and type those. Any comments? Any comments at this stage? Is everyone comfortable with a system going into drawdown? Uh, Sherlin's asking, what is the industry average win rate percentage, 60 or 70%? It's a very good question, Sherlin. It's actually it's not easy to answer, and I would say that some traders believe this, and we're going to tackle this in a slide in a moment, a bit later in the presentation. I would hazard that there are systems that are profitable that give a win percentage of less than 50%, and the idea is, well, how does that honestly? How is that profitable? If we're winning only 50% of the time or less, how can we possibly be profitable? So the idea here is we're gonna work on something called our reward to risk ratio. Sherlin, I'm going to ask you to park that for the time being. Don't forget it. It's an important question. We're going to address it a bit later in the presentation. Now, okay, traders are notoriously impatient. Notoriously impatient. Okay, we are constantly and perhaps consistently chasing the market or entering into a trade where the signal hasn't quite completed, but it's almost there. And what we're trying to do is, when there's no system, there's no setups per system, okay, we start looking for setups that are not part of our system, okay? Start looking for, so if we're looking for a swing trade, and let's just say our swing trade and my personal swing trade, or my personal entry condition, I wait for a pullback. I wait for a pullback. If there's no pullback, I generally am not able to get into a trade. But let's just say that there's no pullback. The market's running hot. Well, we don't want to miss the market, right? The market's starting to run hot. So what we do is we look for breakout trades. We start looking for breakout signals, which aren't even part of our system, okay? Well, that's a mistake. It's a mistake. What we need to do is, when we approach the market, we've settled on a system, okay? Remember system A, B, C. We've got to respect that system, grow comfortable with that system, and trust that system. And the idea is that if there are no setups per that system, that's okay. You don't have to trade every day to do well on the market. You really don't have to trade every day to do well on the market. What you need to do is you have to be consistent with the system. You have to be consistent with your system. Because if we don't have patience, guess what happens? It's going to force us. It's going to force our trades. Patience is tremendously important, but I, I am one of the most impatient people, and I tell you that the lack of patience here puts us into chasing markets, entering too early, entering too late, revenge trading, and it's all circular. Everything on a psychological level is tied in together. It's all tied in together. The reason that we have a lack of patience is because we all want to make money as quick as possible. We all want to make money as quick as possible. So all of these mistakes are interrelated. And if we start being aware of what these pressures are on us as traders, we can slowly start working on them. And because they're interrelated, if we can start improving on one, hopefully it flows on and we have some control on the others. Alex says, patience comes with age. Perhaps we should be forbidden to trade before 30. Interesting. I definitely, as I get older, Alex, I must say that I have settled down a little, but only very late in life. Martin writes something that is tremendously important. Yes, I should have said this, and thank you very much for bringing this up, Martin. The market is always going to be there. Okay, we just need to really understand that we just need to really understand that in order to avoid missing. So what Martin's saying is that if we miss an opportunity, okay, so coming back to my particular style of trading, I look for pullbacks. Okay, in defined trends, I look for pullbacks. It's not it's just the way I trade. It's not a better system than any other system, incurs losses like any other system. But the idea is, if there's no pullbacks, let's say the market's running hot, there's no pullbacks, I can't get into the market. What Martin says is 100% true. It doesn't matter. At some stage, there will be a pullback. I will be able to get into the market. Tomorrow's another day. All right? The market is always going to be there. Always. We don't have to be in all the moves, okay? But we do need to be consistent with our system. Very important. It really comes down to discipline, doesn't it? That yes, this is it's a strange comment. We don't have to be in all the moves, but we do need to follow our system. Let me bring up a drawing tool here. I wasn't planning to, but I think it's worth actually bringing this up. Let me just see. I'm going to bring up Paint. I beg yours, this was just from an earlier webinar. Let me just clear this out. All right. Now, if we trade long enough, eventually we're going to have our trades. They're going to follow a sort of a normal distribution, call it a probability distribution function. And just hear me out here. I don't want to make it too complex, but it's a very important concept, this. Now, this vertical line is what we call the mode, right? Is where most of our trades are going to be. Most of our trades truly are going to be nothing trades. Unfortunately, they're going to be nothing trades. We're not going to make big losses, and we're not going to make big gains, okay? We're going to be sitting around break even. Now, 34% of the time, we'll trade slightly to the right of break even. 34% of the time. So that's the first standard deviation. And we'll make some money, but not all that much money. 34% of the time, we will be trading to the left. We'll make some losses, but it's not going to kill us. It's not going to hurt us unless we revenge trade, of course. But 34% of the time, we'll be, so 68% of the time, we're going to be hovering around break even. And that's now 13% of the time, we actually go past the first standard deviation to the left or the right. Now, this is great if we're to the right of break even, okay? If we're to the right of break even and we make it to the second standard deviation, now we're starting to build the account, okay? The problem is, of course, if we start heading to the left, okay? Now, I think that takes us to 99% if my math is right, which is not always right. 2% of the time, we'll make it to the third standard deviation. here we've made a really nice trade. Okay, we've made a really beautiful trade. If we go to the right, to the left, well, we've just really blown up our trading account. And I think that to get past the third, if I remember my stats, is around about 0.2% of the time. Now, it looks diabolical, right? Because what happens if we move to the left? Okay, well, we don't actually have to worry about moving to the left side of the curve, because we should always be using a stop loss and money management, right? If we use a stop loss and management, we've just cut off the left side of the tail. Okay, we cut off the left side of the tail, means we're going to incur losses up until the first standard deviation. And well, that's okay, because they're going to be offset by our profits to the first standard deviation. But all of a sudden, okay, we don't have a left tail, we don't have any left tail risk, but we've got opportunity to reach the right. Now, think about this, guys. Think about this. We no longer have a normal distribution because we don't have a left tail. Okay, we have what's called a positive distribution. As soon as you have a positive distribution, statistically, your trading account should grow. It doesn't mean you're not going to make losses. Okay, that's not what it's saying. But it's saying that it's impossible if you're disciplined enough to turn a normal distribution into a positive distribution. All of a sudden, the trading account grows. Now, what happens is that in a normal distribution, right on the zero, you have most of your trades. You also have what we call the mean and the median. In other words, the average, okay, is round about the middle as well. As soon as you skew it to a positive, whilst your mode stays at where it is, your mean and your median start moving to the right. Anyways, what I'm trying to say here is that the idea is that it should be okay if we miss a move. It should be okay, because 68% of the time, or at least 34% of the time, theoretically, it should only go to the first standard deviation. If we miss the 13%, if we miss the 2%, okay, it's a little bit more serious in terms of the performance of our account, but it will reoccur. Okay, just understand that. So we don't have to be in all the moves, okay, but we do need to follow our system. If we follow our system and we've skewed the distribution to a positive distribution, well, that's first prize. Okay, does everyone understand that? I sort of wasn't planning to throw in that bell curve, but I just thought it was sort of an opportune time to do it. Does everyone not understand that? Very, very important slide. Okay, no comments, so I'm going to take it that we can move on. So this is what I want to impress upon all of us, and I promise you it affects every trader. Consistency. Instead of jumping from system A to system B to system C, instead of becoming a scalper when we really should be a swing trader, or instead of being a swing trader when we should be a scalper, we want to choose an approach that is adequate for the type of trader we are. Some of us may be scalpers. Well, then that's okay. Some of us may not be, but we want to be consistent in the approach that we choose. Okay, and understand, just as Martin says, the market's always going to be there. Okay, tomorrow's another day, next week's another week. Market's always going to be there. So we're going to start, I think, from now. What I would try and encourage is just consistency in approach. Consistency approach. If we don't have the correct expectations, in other words, remember, incorrect expectations is that get rich quick mentality. And if we're not patient, it's going to lead to us jumping from a scalping system to a swing system to a positional system. And if we're a positional trader and we jump to a scalping system, that's awful, where we're trying to catch maybe sort of in excess of 100 pips. All of a sudden we're okay with 10 pips. That's going to really impact on performance. So we really want to have the correct expectations, and we have to try our best. And it's not It's not easy. I'm the first to concede it's not easy. We really have to try and be patient and wait for the market to set up as per our system. Just we have discussed this, but just some repetition. A string of losses will lead us to look to a new system. This is what we call the beginner's cycle. Okay, we must understand that every single system is going to have a drawdown phase. Every single system. Okay. So whilst what we've talked about chasing the market, well, we don't want to chase systems either. If we keep chasing systems, we're going to find ourselves in all these systems drawdown phases, whereas if we just use one system that's consistent, we wait for that drawdown phase to complete, it moves into its profit phase, okay, and we'll stay in that profit phase until it disconnects with the market and we have the next drawdown phase. But if we keep chasing systems, we can't get the consistency that a good system will give us. Okay, a good system will always go into a drawdown at some stage, but ultimately will return to profitability. And if we jump from system to system to system, we'll never be able to take advantage of that fact. Alex asks, is it inevitable to chase systems? Let me think about that. I think that it is inevitable. I think that it's actually, let me think about this and I'll get myself into tremendous trouble. Yeah, I think it's inevitable and perhaps healthy to some extent. But uh, that sort of healthy to some extent is sort of a very, very short time frame type of benefit, because I think that we've all got to learn, we've all got to become proficient at trading the market, and perhaps looking at different systems gives us an idea of how the systems work, and we can start actually building a system according to our particular profile. So yes, it's probably inevitable to chase systems, but at some stage, you're going to have to choose a system that you're comfortable with and trade it. Now, you don't have to have one system per se. You may choose 2 or 3 different systems, but the idea there is that each one of those systems you're going to need to trust. The chasing of systems, remember, will inevitably lead to you falling more often than you should be into a drawdown phase. Also, we're all very unique as traders. There's no ways that we all trade the same. Whilst we may be very similar, I would suggest, and I'm sure you guys have heard this before, that if I give you a system, okay, we've got a number of people on this call, and it's a consistent system, and I say, let's meet back here in a month. If we meet back here in a month, I would suggest that each one of you has amended the system to gel more with your particular trading personality. So what was initially one system has now become a multitude of systems. And I think that's healthy and it's good, because you are making the system your own. And that's ultimately what you're trying to do. But once you've made the system your own, or once you've chosen on how you want to approach the market, you've got to, at some stage, sit down and trust that decision. Does that help, Alex? Cheryl asks, I trade a daily system. If I also traded a shorter timescale system, what would be your choice? Again, it's very difficult for me to answer that, because of course your risk profile, you know, your propensity to seek risk or avoid risk may be very different to mine. Let me answer this. It's not really an answer, Cheryl, but my system, what I use is a swing system. I don't like scalping. Okay, very seldom I would positional trade. If I positional trade, it's mainly for a carry. So I generally look for a swing, but sometimes the swing goes overnight. So I would be true to that, if that makes sense. So Would I recommend a shorter timescale for you? I really think that if you are choosing that, you need to demo it first and make sure that, number one, you're comfortable with it on a demo trading, and also understanding that a demo system is not real trading. It's no real trading. So once you've got real money on the line, it starts having that psychological effect, which can really shake you out of trades. Understand, I'm a cautious trader considering 2 minutes on the Dow. Sounds very close to price action there, Cheryl. If you're cautious and you're looking at it, am I understanding this correctly? You're looking at a 2-minute chart on the Dow? It is very close to price action, if I understand that correctly. All, yeah. Okay, so look, what I would suggest is perhaps just make sure you're comfortable with it on a demo account, and I mean, do a mass amount of trades on it. I'm talking a spreadsheet with 20 columns, sort of, or 10 columns, 20 rows. You know, yeah, and just see. Yeah, 2 minutes is very close to price action there, Cheryl. Very close. It's you see, 2 minutes is very noisy as well, right? You're going to get a lot of noise on a. I don't want to dissuade you, of course. You know, 2 minutes is very close to price action. All right, let's go through to the next. I think if you would like, Cheryl, perhaps just email me at arshaw@fxm.com. We can discuss it. But yeah, it's very close to it's very close to price action. Very close. Okay. We addressed this in a previous ad hoc webinar. Okay, so I'm not going to get into too much detail here with a trading plan. But what I will say, okay, what I will say is that every single one of us, if we come into the market, we need a trading plan. Why do we need a trading plan? Because it's effectively your business plan. Okay, it's your business plan. We all need a trading plan, but having a trading plan in our minds, okay, is not a trading plan. It must be written down, and it's a living document. It can be changed and amended as your style of trading is changed and amended, but it needs to be written down, because often we'll go into the market and we won't know what to do. We won't know what to do. Should we enter or should we exit? The trading plan has to be detailed enough so that when we are confused as to what our action should be, we need to be able to consult the trading plan. Okay, so it's a point of reference, and it's, as I say, a living document. But you need to know your entry criteria, your exit criteria, your risk criteria, your analytical criteria. It really needs to be a important living document. Alex says, why write it down? Do systems need to be that complex? I would suggest it needs to be written down because in my mind, Alex, and bear with me, it makes it more concrete. If it's just in our mind, okay, so I'm going to trade when we get a fast-moving average going over a slow-moving average. Let's use the 5 hour as the fast. Let's use the 10 hour as the slow. I'll wait for that cross. If we get a cross, okay, now I could enter. And then we look at the market, and the 5 hour looks like it's about to cross over the 10 hour, but when we go down and we see that the 3 hour actually has crossed over, maybe that's good enough. Let's go in and take the trade. So I think that when we don't have it written down, it's perhaps open to abuse. Whereas if it's written down, we actually thought about it, we've committed it to paper. And remember, you can adjust it and amend it, but it's really there as a living document it's your business plan. Yes, write it down to improve self-control and discipline. That's exactly, I think, the exact reasons to do it. Exact reasons to do it. You consult it, and continuously refer to it, and when things need to change, they need to change. You should know what if you're going to pyramid in, what your rules are for pyramiding in. If you're going to scale out, what are your rules for scaling out? If you're putting on a trade, what is your risk percentage? When you put in a stop loss, where does that stop loss go? It's really all about maintaining control in an environment that has little to no control. So having a trading plan is one of the elements that helps perhaps um, um, keep that discipline in such a random environment. Martin writes, have some strict do's and don'ts in front of you as a great little reminder. Yeah, absolutely. Perhaps having some sort of little post-it note in front of you. Riza says, would I give at least one example or a sample of a system? It looks like the webinar is very general without giving at least an example to open a window to understand you. Yes, let me think about the response there. The webinar itself is all about mistakes that we made. Mistakes, Riza, very much exist on our psychological level as traders. It's very, very important that we understand that there are a number of areas as traders that are either going to make us or break us as traders. Okay, so what are those areas? So the three that are generally talked about, and the first time I saw this was in a book called Trade Your Way to Financial Freedom by a author by the name of Van Tharp. And the three variables which we affect us as traders are: number one, method, which is what you're asking for. Can we have a method? Number two, money management. And number three, psychology. Okay, now if you have a perfect method, okay, Reza, if you have a perfect method, it's only going to account for 10% of your success, according to Van Tharp, who's a doctor of psychology, specifically specializing in trading psychology. 10%, 10% is of your success will come down to your system. Only 10%. 20% is going to come down to your money management. So 30% is going to be a method or system plus your money management. 70% comes down to psychology. The mistakes that we're talking about now are all within that 70% framework. This is the idea here, okay, is that you can have a very low win percentage methodology, and as long as your psychology is on par, you can potentially still be profitable. You've got to understand that this that we're talking about right now, making market mistakes, okay, is really what's going to determine your success. If you want to discuss a system, by the way, I don't mean to kind of just sort of not address your I think your question is very valid. What I may suggest, Reza, is that you contact me on my email, rshaw@fxcm.com. I'll show it right at the end of our webinar. Now, the next part of our webinar is, I beg your pardon, the next part of the slide, I think, is very important, and I don't think it applies to trading, okay? But I think that it can be applied successfully in most endeavors, is that we want to be process oriented, okay? We want to have a process which is very much about following our trading plan. And if we follow the process that is stipulated in our trading plan, okay, we all of a sudden switch our focus from that get rich quick mindset, which we discussed earlier, to a more processed focused mindset. In other words, the profits all of a sudden become a result of the process that we follow. Okay, the byproduct, it's a byproduct of following a process. The byproduct all of a sudden is the results Okay, so you follow your process. You cut your losses when you need to cut your losses. You let your profits run when you need to let your profits run. Okay, and the byproduct is your results. Alex writes, making mistakes is good in the long run. Learning is through mistakes. Yes, and I've learned a lot, Alex. Let me say, I've learned a lot through through my career. But the idea here is we really want to try and move away. Okay, we want to try and move away from the focus on the get rich, on the results, on the money. We want to move away from that. We want to become disciplined, and we want to follow the process. And then just remember, guys, that a good trading plan does not mean no losses. Okay, if we make losses, it's part of the bell curve. Okay, 34% of the time you're going to hit losses to the left of break even. Remember, that's just business. Okay, those are business costs. If you are involved in any business, you're going to incur business costs. In our business, losses are the business costs. Iron like discipline, just like the redcoats in the 18th century. Indeed, indeed. Now, another very interesting psychological mistake that we make as traders is not pulling the trigger. It's not pulling the trigger. Okay, in my opinion, this is related to you being process oriented. So what does that mean? It means we avoid actually taking a trade. We have a setup. The setup looks good. We should theoretically enter the trade. Okay, and we don't. And the question is, well, why aren't we entering the trade? We've got a valid setup, whatever methodology we use. And again, Reza, if you just email me, we can sort of open that up to discussion. But the idea here is when we've got a valid entry and we don't take it. And the question is, why won't we take it? Why don't we take it? And before I give my opinion, any idea there? Anyone want to type why someone would not pull the trigger on a bona fide setup? What would hold us back? What would hold us back? Yeah, it's so interesting. Everyone's saying basically the same thing. So starting with Alex, he says, well, you don't pull after a string of losses. Martin says that our fears, that's why we don't pull the trigger. Cheryl writes, the fear of loss during a bad run. Phil says, fears of being wrong. Sherlin says, emotions. Michael, not sure of the trend. And it's all uncertainty. It's all related to fear. It's uncertainty. And it's all about perhaps the fact that we don't have a sure thing. It's really what it comes down to. We don't have a sure thing. Now, if you are not willing to take on some risk and risk is really uncertainty, isn't it? You've picked an interesting endeavor because every single trade is uncertain. Every single one. When you put on a trade, you don't know whether that trade is going to be profitable or not. Okay, every single trade is uncertain, but your trading plan, that's not uncertain. Okay, and if your trading plan is not uncertain, well, then the process is not uncertain. So again, I want to reiterate, if we focus on the process, not on the result, okay, perhaps that will help us in terms of pulling the trigger at a time when we've just gone through a drawdown phase. A drawdown phase is no fun. Okay, let's not kid. And it really stokes the fear. I mean, a drawdown phase, we're talking a consistent string of losses. We may have sort of 5 losses out of the last 7 trades, dispersed in between somewhere we've got two wins, and we get so emotionally battered that when we get a valid signal, we just actually can't pull the trigger. But if we follow the trading plan and we understand that every system does have a string of losses at some stage, and at some stage that the string of losses should come to an end, The markdown phase should come to the end, and if the trading plan is solid, okay, it should sync up with the market again. So again, you can see how everything here is interlinked. If we have an awareness of this of the psychology, and if we can just start controlling 1, 2, 3 of these trading mistakes, well, they're all interlinked, okay, and all of a sudden we start controlling a lot more of the mistakes that we are susceptible to. Okay, so again, I just want to reiterate here that having a trading plan, in my opinion, it should be written down. It doesn't mean it cannot be changed. It's a living document, but it should be clear enough that when you're confused, you need to just take one glance at it, look at it, and you should be able to clear that confusion up fairly quickly. Another mistake that we make, and we see this all the time, okay, I see this all the time, too much leverage. Too much leverage, okay? And we all know that leverage is a double-edged sword. And why do we use leverage? Is because of our get rich quick mentality. We all want to get as much money into our trading account as quickly as possible. And I understand that because I promise you, I've done it in the past. Now, we all know that leverage is a double-edged sword, isn't it? Okay, we know that profits will be large, but so will losses. Profits will be large, but so will losses. Now, let me pose a question to the attendees here. What's the big deal? If your profits are going to be large, if your losses are going to be large, what's the big deal? So wouldn't one offset the other? Wouldn't one offset the other? Any ideas with regards to large profits, large losses? Any idea? The truth of the matter is, so Alex says if one upsets the other, then the account will not grow. It's even worse than that, Alex. It's even worse than that. Martin writes, greed and fear sets in. Yeah, absolutely. If you not disciplined and you're not approaching the market as a professional, then you very much, Martin, I would suggest, susceptible to the get rich quick mentality. But mathematically, we're in big trouble here if we don't respect the losses. Okay, mathematically, the losses are going to hurt a lot more than the large profits that you're going to gain. Think about it this way: we've got $100, okay, and we lose 10%. So on $100, we lose 10% means we've lost $10. We're sitting with $90. Okay, central limit theorem. Very Sam, it's very interesting that you brought up central limit theorem. I actually studied it yesterday. Okay. Uh, um, all right. So the idea here, okay, um, the idea here is that a 10% loss is not going to be offset by a 10% gain. Very important. A 10% loss is not going to be offset by a 10% gain. If you make a leveraged profit of 10%, it's not going to offset a leveraged loss of 10%. Okay, you got $100, you've just lost $10, you're sitting on $90. Okay, now you make 10%, but you're only making 10% on your 90. You've only made nine bucks back. So from $100, you're now sitting at 99. There's a dollar missing somewhere. That 10% gain has not offset the 10% loss. It gets worse. If you've lost 20%, so you go from $100, you go down to 80. Okay, what do you need percentage-wise to get from 80 back to 100? So you've lost 20. Okay, you need to make 20. You need to make $20 back from your 80. Well, $20 of 80 is not 20%. It's 25%. So a 20% loss is offset by a 25% gain. If you've lost 50%, you need to make 100% just to break even. So trading with too much leverage mathematically is absolutely dire. If you make a big loss with too much leverage, it's almost and I would say probably impossible to come back, depending on how big the loss is. So the idea here, of course, is that we want to respect how much leverage we use. And as I say that, Cheryl's written something that is extremely important. Now listen to what she writes here. Keep trading to 1 or 2% of bank and consider smaller margins with the stop loss. Look for more winners, even if smaller number of pips. Okay, so what I would suggest, what Cheryl writes, if you stick to 1% or 2%, 2% already is you're starting to look quite heavy in terms of your risk profile. But let's just say you keep it at 1%. Okay, although you are leveraged, the leverage in itself is generally controlled. It's generally controlled. Okay, and you should never ever be margin called. Exactly, Alex writes. It's like a football game. It's hard to come back from 5-0. Yeah, exactly. Eric writes, if trades go on the opposite side, there'll be more losses. Yeah, exactly. That's exactly what we're suggesting here. Now, let me go back one. Too much leverage. Yes, that's fine. Sorry. Going through to the next. Aha, sorry. Wanted to just bring this line up here. Whilst the outcome is not in your control, money management is in your control. Going back to exactly what Cheryl says, keep trading to 1 or 2%. Okay, so your exposure to the market is completely in your control. It completely. Remember earlier and I think there's a slide on this later. We've said that professionals that pride themselves on the amount of control in their particular vocations come to the market being completely used to exercising control in their daily work, and all of a sudden they are exposed to the market, which has close to zero control. The market's going to do what it's going to do. It's not going to do what you want it to do, right? So whilst you cannot control the outcome, every single trade is going to be random. Every single trade is going to be random. Okay, the positive the positive sloping the positive bell curve. Okay, so we're changing it from a normal distribution to a positive distribution. Well, that actually is over time. Okay, that's over time. So it's the same thing as kind of flipping a coin. It's like flipping a coin. Every single time you flip a coin, it's independent of what happened. So if you flip a coin and it comes up heads, the chances of you coming up heads or tails in the next coin, in the next toss, doesn't matter what you flipped previously. It's an independent flip. But if you have to flip the coin enough times over time, you will get a distribution of about 50-50. It's exactly the same with trading. Every single time you trade, the trade that we put on now has got little to do with the trade we put on yesterday. But over time, the positive distribution or the positive expectancy should bring money into the trading account. Does that make sense, guys? It's quite deep. We go into this fairly deep. It's very, very important. It's very, very important. Does everyone understand that? It's really all about mathematics. Statistical facts, exactly. All right, let's go to the next slide, which we've talked about, revenge trading. Over time, our methodology will have an associated win percentage. Okay, and that was a question earlier. I think it was Cheryl that asked, what is the sort of industry standard? I'm going to talk about that. I think around about this slide. So we're going to have an associated win percentage with our method. Not all methods have the same win percentage. Some may be higher than others. It doesn't mean the low ones are less profitable. In fact, the ones that are with a lower win percentage may in fact be more profitable. How is that possible, we may ask? Well, I'm going to go through that in a moment. It doesn't matter if our win percentage is positive. Okay, it doesn't matter if our win percentage is positive. What it still means is that our trades are going to be independent of one another. They're going to be independent of one another. And yes, I would concede that, look, if for example, Brexit uncertainty was hammering cable, then the line of least resistance up until October last year was down. Okay, so the short trades possibly had the stronger probability, but each trade you put on would still be independent. Still be independent. Okay, so yes, going back to Reza's point is that, well, how do we trade? Well, Reza, again, I would encourage you to email me, but you want to try and line up your trading with the longer term fundamentals and trends. Now, uh, yeah, I've talked about this a bit earlier. Uh, think of a coin toss. Every toss is unique. Every trade is unique. This implies uncertainty. So because of this uncertainty, we fall back on our trading plan. Okay, we fall back on our trading plan. And the only way to deal with this uncertainty, as Cheryl says, and you can see that we're starting to actually enter a certain pattern here where things are starting to be repeated. Okay, the only way to deal with uncertainty is risk management. It's the only way to do it. Exposing ourselves to risk without managing our risk, well, that's going to be detrimental. Let's just talk about win percentage. Okay, I'm going to tell you guys how you can 100% be profitable. I'm about to teach you how to be 100% profitable. Okay, it's a big, it's a big call. A big call. Okay, a big call. All right, let's bring up our drawing tool here. Alrighty. Two axes. Two axes here is our win percentage. Okay, so the x-axis has our win percentage. Let's move this a bit back. The y-axis has risk. Let's make it reward to risk. Let's write it this way. Okay. Now, no, that's not right. Sorry about that. Let's just make sure it looks okay. Good enough. Good enough. Good enough. All right. This is the question I pose. This is the question I pose. The question is as follows. Which is more important to the trader, the x-axis or the y-axis? So what I'm asking is it more important to concentrate on win percentage, or is it more important to concentrate on reward to risk ratio? What do you guys think? Alex writes reward to risk. Sherlin says reward to risk. Sandili reward to risk. Martin R to R ratio. Michael reward to risk. Okay, that's brilliant. It's very good. And most people, when they first come to the market, myself included, Kobus reward to risk concentrates on the win percentage. That's what we call the search for the holy grail. I think there's a slide a little later. Okay, the idea is while we're jumping from while we're stuck in the beginner cycle going from system A to system B to system C, it's because we're concentrating on win percentage. So the way it works is as follows. Okay, so this is not to scale, so just bear that in mind. So assuming we have a win percentage of 50%, that means that if we trade 10 times, 5 of the trades are going to be winners and 5 of the traders are going to be losers. Okay, and reward to risk, if we put 1 to 1, means that for every trade where we are successful, we're going to earn $1, and every trade where we lose, we're going to lose $1. Well, that puts us slap bang on this curve, which actually turns out to be the break-even curve. And this is all driven by a formula, but we're not going to get that in now. But if you are sitting on this curve, anywhere along this curve, you are breaking even. You're not making a profit, you're not making a loss, you're breaking even. So in order for you guys to be profitable, okay, or for anyone, myself included, we have to be trading here. It's what we call the profit zone. So we have to be trading northeast of the break-even curve. Now, watch this. 10 trades at 50% win. Okay, so that means we're making $5 on the wins. Means we're making $5 on the losses at 1-to-1. Gives us zero profit or loss, because the $5, okay, profit is offset by the $5 loss. That makes sense, okay? And you can see, so we're sitting on break even at 50%, 1-to-1. So the question that we ask, okay, the logical question is, well, we want to go into the profit zone, okay? Because if we go into the profit zone, we're making money. But there's only two ways to go into the profit zone. We can either improve our win percentage, or we can improve our reward to risk ratio. So win percentage, let's see if we can push it up to 60% and keep it at 1-to-1. What happens there? So we've got 10 trades at 60%. That means that we're making 6 on the wins, 4 on the, we lose 4 on the losses. That gives us a net of $2 net profit. Okay, and so we can improve on the win percentage. The problem with the win percentage is that it's very difficult to improve the win percentage. That means we're jumping from A to B to C. We've seen what happens. The beginner cycle, we get caught in the trying to get into the perfect 100% system. Which I promise you, I've been looking for it since the late 90s. It doesn't exist. Well, I can't say that for certain. By the way, there's a good book if anyone wants to read. The Man Who Beat the Market. It's all about quants. Okay, so but look at this. What happens if we move our break even? So we keep the win percentage at 50%. Okay, but now we've changed our reward to risk 2-to-1. Okay, so let's do now over here. 10 trades at 50%, but now we're looking at a 2-to-1. Okay, so all of a sudden we're not making $5 on our wins, we're making $10. Okay, we're still making $5 on the losses. Check what the net profit is. We've just made a considerable improvement. So the win percentage is slightly better, but when we start playing around with our reward to risk ratio, we're considerably better. Okay, so that's very, very important to know, that if we can have the patience to let the swings run. Remember that we're talking about going into the second and the third standard deviation. Well, all of a sudden we're starting to really make an impact on our trading account. Any questions there? Any questions? Please go ahead, type those through. All right, starting capital. So I think we all understand this is a big mistake. Starting an account with a smaller account, and I understand people can either afford it or they can't. But what I may suggest, if you're starting with a smaller account, okay, just understand that there's going to be you're going to be more restricted. Alex, I can't answer that. So Alex writes, I would be curious to know the average IQ of people who are profitable. Is there a correlation between intelligence and profitability? I can't answer that. I would suggest again that the brightest members of society, your sort of doctors, lawyers, engineers, accountants, the professionals that have a certain control in their day-to-day jobs, may come to the market and experience initial pain as they adjust to the fact that the markets have little control. Sherlin says the answer to that is no. Just follow a proven trade and plan. Well, there you go. There we go. Okay, so regardless of the account size, I want to just stress risk management is essential. Okay, and expectations must be realistic with a smaller account size, particularly to sort of the area sort of that I that I'm in, there is there is a problem in terms of distribution of wealth, and people come to the markets. They of course want to participate, but the account sizes are smaller, and that's fine. Okay, that's fine. But just understand they're going to be more restricted, and that understand that a smaller account is going to limit just how many lots one can purchase. Okay, the biggest reason that account blows up is due to lack of risk management. Okay, and I would uh, suggest that in this business, less is more. I would suggest less is more. It takes time. If we are all disciplined, and I'm very ill disciplined. Okay, if we're all disciplined, okay, and we trade as professionals, um, eventually compounding catches up, and the account starts growing. And we must acknowledge that. We must acknowledge that. Okay. 2% risk per trade cumulative is the absolute most, and less is better. So if you are willing to put on 2% risk per trade and you decide you're going to put on 2 trades, well, that means each trade is only allowed 1% risk per trade. So that 2% is cumulative. You should never be able to go higher than 2%, and that's um, written in the textbooks. Trade Your Way, I beg your pardon, Alexander Elder's book escapes me for now. Trading for a living. Okay, trading for he advocates 2%, but I promise you, in this business, less is more. Less is more, and eventually, if you approach it with the fact that you're using a stop loss, that you are using risk management, you no longer have left tail risk, so you don't have a normal distribution. You've got a positive distribution. Because you've got a positive distribution, okay, the account starts growing. But if you start applying a risk percentage per your trade, eventually that risk percentage starts compounding, and it really starts growing. And all of a sudden, the gains are noticeable in the trading account. We've talked very much about the fact that we are trading in a low control environment. Well, risk management is the one area where we can exert control. It's the one area where we can exert control. We all know exactly how much we are prepared to expose ourselves to in terms of losses. Well, that is a big deal. In a market, there is little control, but all of a sudden we are prepared to risk 1% of our trading account. That's a big amount of control compared to somebody that willy-nilly puts on a position and has unlimited losses, potentially unlimited losses, or may expose him or herself to margin call. So all of a sudden, when we put on risk management, we're no longer affected by the get-rich-quick mentality. No longer affected by that get-rich-quick mentality. We all of a sudden become professionals in an environment that demands that we be professionals, because if we're anything less, we're going to be hurt very badly. We're going to be hurt very badly. Think about it this way. Let me pose a ridiculous question to you guys. If I had to play soccer against Lionel Messi, or football, okay, depending which part of the world, if I played football against Lionel Messi, who's going to win? Who's going to win? Alex writes Messi. Okay, a few people typing in Messi. Yeah, Messi's gonna run rings around me. Now, let me. Cheryl says me, but just. The idea is as follows. Okay, let's adjust this a little bit. If I play at my 10 out of 10, but Messi agrees to play at his 5 out of 10, who's gonna win now? Honestly, who's gonna win now? Alex, still Messi. I appreciate the comments that suggest me, but I assure you it's not going to be me. It's Messi. The point is that when you're competing against a professional or the very best, okay, you're at a distinct disadvantage. It's the same thing with the financial markets. Okay, you're up against the big banks. Okay, you're up against CFAs, you're up against MBAs, you're up against PhDs. you're up against CMTs, okay? You're up against really, really strong competition. That's the reality. That's the facts on the ground. Okay, so the idea here is that if you are looking to participate in this market, it demands that we approach it with being a professional, because that's who participates in this market, and we do that by acknowledging that we need to control the variables that we can control, because the environment is has so little control. And one of the biggest areas that we can exert control is risk management. And once we understand that risk management is a massive area we can control, well, all of a sudden it starts affecting our psychology, which is 70% of our success, in a very, very positive way. Okay. Now, Reza writes, given the loss-win ratio of 1-to-1, what do you mean in terms of 2% risk? Aha. Okay. So let me put it as follows. Hold that thought, Reza. I'm going to complete this slide. I'm coming back to your question in a moment. Okay. So what I'm saying to you guys is that I believe that we shouldn't aim to be the best traders. Okay. We shouldn't aim to be the best traders. We should aim to be the best risk managers, because if we're the best risk managers that we can be, the profits will take care of themselves. Now, let's just go back to Reza's question. Sorry about that. Let me just we don't have to save anything here. So the idea here, let's just say there's a $1,000 trading account, just for ease of calculation. You got $1,000. Now, what you want to do is you want to multiply this by 2%. Okay, so if you're prepared to risk 2%, you multiply, okay, the $1,000 by 2%. Well, that turns out that equals 20 bucks. Okay, it turns out that's 20 bucks. So on a $1,000 account, if you're prepared to risk 2%, you're only really looking to risk $20 per trade. Okay. Now, what that means now is we've got to understand where the stop loss is. So let's just say that the stop loss, we put 20 points away, or 20 pips away. It's 20 pips. Then what we do is we take our $20 that we prepared to risk, divided by the 20 pips, and we get the answer of 1. What does that 1 mean? Well, 1 is the amount of, you're allowed to trade 1 mini lot. And you've just now completely calibrated your position to a 2% loss. What is a mini lot? Mini lot is 10,000 units of base currency, I believe. 10,000 units of base currency. So that is the formula to apply risk management. Does that make sense, Reza? Let me show you a web page. I'll bring it up, which is tremendously useful, actually. Bear with me a moment, and you should all be aware of this page. It's babypips.com. babypips.com. Now, I'm aware that we are over time. I apologize. I'll try and get through it as quickly as possible. If we go through to Baby Pips, Reza, take a look here at the tools over here. Okay. Can you see the position size calculator? Just click on that. Now, assuming you've got a US dollar account, so it depends if you've what currency your account's in. Let's just say you've got $1,000 in that account. We're willing to put on a 2% risk. Our stop loss is 20 pips, and just make sure you choose the correct currency. I go calculate, and it tells you exactly how much you are prepared. You should be able to trade. Does that help, Reza? I hope that helps. Okay. Let's just see. There's a few other questions. Graham's asks, would you move your stop loss in a winning trade? I would say most definitely yes. Okay, so you want to get your stop loss to break even as soon as possible. But that again, Graham, has to be in your trading plan. You have to know exactly at what point you start moving and trading your stop loss. And you've got to know where you're going to put the stop loss. Okay, one of the ways that you can trail a stop loss, incidentally, Okay, I do it with moving averages. Okay, but one way you can do is, we know the market tends to zig and zag. Okay, sorry about this, not the neatest, but every time a trough is locked in, you can kind of shift it up, and eventually you get hit out. Okay, so you'll never get out at the top, but you've captured part of the trend. All right. Don't be the best trader, be the best risk manager. This will assist you in making educated trading decisions. Okay, I'm going to just speed up a little here. We have talked about a system chasing. That's getting the search for the holy grail of systems, the 100% system. It doesn't exist. I've tried my hardest to find it. And if it does exist, it's certainly not going to be made available. Now, you need to find a system that makes sense to you, something that reflects your style and personality. We have addressed this. I think it was Alex that asked, well, don't you initially chase systems? And I would agree that you do, but at some stage we are going to have to settle and be content with our approach. Remember, we want to focus almost totally on risk management and trading psychology rather than the actual system. The system, according to Van Tharp, is 10% of success. 10% of success, where risk management and trading psychology is substantially more. Okay, and this will allow us to be process-oriented as opposed to outcome-driven. Moving on to our next slide, focusing on our win percentage. Okay, so we've addressed this, focused on reward to risk rather than our win percentage. Okay, I think we have covered this in spades. Okay, in your trading, you will have losing trades. And again, I just want to reiterate, you cannot avoid that. It's a business cost. It just must be accepted. Okay, must be accepted. All right, we're on slide 15 of 20, just to give you 15 of 20, and I think the last two are just sources. Over trading. Remember, we mentioned at the beginning, if we are looking to make quick money, okay, we tend to chase the market, or we're getting too early. Okay, we revenge trade. Look, the idea is we don't have to trade every day to be profitable. We don't. What we want to do is we want to look for quality over quantity. Look for quality trade setups, and really, if there is no setup, don't take the trade. The market is always going to be there. Tomorrow is another day. Next week's another week. So it's very difficult, because I have done it in the past. We tend to chase trades. Okay, I reiterate, focus on the process. Focus on the process. Accept responsibility. We have addressed this as well. Use a system that makes sense and then make it your own. You'll never be able to carbon copy somebody else's trading style. It's very difficult. They're going to have a distinct trading personality, and you're going to have a distinct trading personality. It's just our human condition, the way we made up. So whatever system you decide to settle on, something that makes sense to you, you'll see that when you revisit the original system a few weeks or a few months later, you would have made some adjustments to it, some adjustments that would certainly reflect your particular trading personality, and that's a good thing. You've got to really make the system your own, and that's because every single one of us has a very unique style. Okay, we have a very unique style, and because it's almost impossible to just carbon copy somebody's trading, it has a very important implication. It means that we have to be responsible for our own trading. Okay, if somebody gives you a system, they're no longer responsible for that. You've got to make that system yours, and you've got to be comfortable with it. So it's actually quite liberating when we accept that we're responsible for our own trading. We're no longer able to blame anybody for our sort of mistakes. We accept them, we learn from them, and we turn them into successes. So we really want to accept responsibility, because the truth of the matter is nobody else is going to make money for us. Okay, it's our responsibility alone. Alex, yes, you can get you can't get the slides. You can get a recording of the slides. Just send me an email. I'll shoot you a recording of the presentation. I'll put my email in right at the end. Okay, we on slide 17 of 20. I believe this is the very last slide. We have very little control. It's very difficult for the human being to operate in an uncontrolled environment. Okay, so that's why we have to have a trading plan. It gives us control in an environment that is very difficult to operate under in any other fashion. So a trading plan is very, very important. And again, I would reiterate that it's a living document, and it should be written down and be able to, you should refer to it at a time when you are confused, and it should clear that confusion up fairly quickly. Okay. The fact is that we don't really thrive in a environment where there's no control. It's hard for us to accept that there's little control in the market. I mean, how many of us have put on a trade, the trade's gone against us, and we are saying, well, you know, the market's going to come back because we've put on the trade. Say we go long, the market goes down. We say, well, we're just going to wait it out because the market's obviously wrong. It doesn't work that way. We are the ones that are wrong. The market's going to do what the market's going to do. We won't be able to influence the market one iota. We're too small. Okay, so the market is going to do what the market is going to do. This is interesting. Well, we're going now into philosophy. So Alex says we have no control over the reality surrounding us either. Okay, very, very interesting. Very philosophical, and I'm not sure I would be able to comment on that, Alex, but interesting. The only variable that we can control is money management. Okay, the only variable we can control is money management. So we must jump on that. Okay, must jump on that. It gives us control in an arena where there is no control. James, I'm going to put out my email address. If you just shoot me an email, I will respond with the link. Okay, I'll respond with the link. I'm going to put it up screen in a moment. Okay. As such, it should occupy a lot of our thinking regarding trade. So we should think about money management a lot, okay, because it's quite possible to make a string of losses. With that, ladies and gentlemen, it brings me to the end. This is the sources, babypips.com, FXCM.com, and Trading in the Zone. This is a really good read, okay, Trading in the Zone by Mark Douglas. It's when I first read it, I found it a very difficult read, okay, but if you stick with it and revisit it again and again, it will improve your trading, in my opinion. And that is the conclusion. It's I'm not Mark Douglas. I'm Russell, but Mark Douglas's book, absolutely, yeah. Martin writes, first book I read was The Way of the Turtle and Trading in the Zone. Great books. Yeah. Let me put my email address on screen for everyone. Bear with me a moment. I'm just going to bring this up again. All right. So if anyone needs to get hold of me, let's make this a little bigger. Just shoot me an email to okay, so this is the email address to reach me. The other book, Cheryl, Trading for a Living by Alexander Elder. There's actually a newer version. It's called The New Trading for a Living by Alexander Elder. The New Trading for a Living by Alexander Elder. Sherlin says, Mark Douglas has some great YouTube videos as well about trading psychology. Okay. Thank you very much. I must actually look into that, Sherlin. Thank you very much. Okay, so this is my email. Any final questions before we log off? Please go ahead and type those through. Alex. All right, Eric, cheers. Yes, I'm from South Africa, and I am a Springbok fan through and through. All right, Cheryl. Thank you very much. Thank you very much for joining us. Any questions? Go ahead, type those through. I'll just wait another sort of 15, 20 seconds, and then we will log out. All right. Thank you very much, Reza. Thank you very much. Thank you, Martin. All right. Thanks very much, guys. I'm going to log out. There's no questions coming through. And I really do appreciate you joining me this afternoon.